The global economy just hit a critical turning point this week, and if you're wondering why your investments, your currency, or even your job might be affected, you need to hear this. The world's financial order is literally reshaping before our eyes, and I'm about to break down 5 major developments that happened just this week that will impact every single one of us. We're talking about central bank wars, currency collapses, growth warnings from the world's top economic institutions, and something that should terrify every investor. Global reserve managers are now questioning the stability of the US financial system itself. Stay with us because by the end of this video, you'll understand exactly what's happening to the global economy, why it matters for your financial future, and most importantly, what you can do about it. Let's dive in. Let's start with the biggest story that's flying under the radar. Central banks are now playing completely different games, and this divergence is creating massive opportunities and risks in global markets. This week, the European Central Bank made another aggressive move, slashing all 3 of their main benchmark interest rates by 25 basis points. Now here's what makes this significant. Since June 2024, the ECB has cut rates by a total of 200 basis points. That's 2 full percentage points of cuts in just over a year. Meanwhile, the US Federal Reserve, they're barely moving. The interest rate gap between the United States and the Eurozone is now wider than it's been in years, and this creates what economists call carry trade opportunities, but also massive risks. When interest rates diverge this dramatically between major economies, it triggers massive capital flows. Money chases higher yields, which means investment dollars are flowing toward US assets, while European assets become more attractive for different reasons. This isn't just economic policy, this is economic warfare, and the weapons are interest rates. For investors, this means your international portfolio allocations need serious reconsideration. European stocks become more attractive as borrowing costs drop, but currency risk increases. US bonds offer higher yields but face potential currency headwinds. Now let's talk about what's already happening as a result of these policy divergences. The US dollar is experiencing a significant decline against major currencies, and this is creating ripple effects across the global economy. The euro just hit its highest level against the dollar since 2021. Let me put this in perspective. If you were planning a European vacation last year, you needed about $1.05 to buy €1. Today, you need significantly more. This isn't just affecting your travel budget, it's reshaping global trade dynamics. Here's what this means in practical terms. Imported goods from Europe are becoming more expensive for American consumers. That German car, that Italian wine, that French cheese all getting pricier? But flip the script, US exports to Europe are becoming more competitive, which could boost American manufacturing and employment in export-oriented sectors. But here's the deeper story. This dollar weakness is happening at a time when the dollar's status as the world's primary reserve currency is being questioned. When major economies start moving away from dollar-denominated transactions, it creates a feedback loop that can accelerate dollar decline. We're already seeing this with initiatives like BRICS payment systems, increased bilateral trade agreements that bypass the dollar, and central banks diversifying their reserves away from dollar-dominated assets. This week's currency movements might be early signals of a much larger shift in global monetary dynamics. Now for the reality check that every investor and business owner needs to hear. The world's leading economic institutions are painting a picture of sustained mediocrity in global growth, and the implications are far-reaching. The International Monetary Fund is projecting global growth at 3.3% for both 2025 and 2026. Now that might not sound terrible, but here's the context. This is well below the historical average of around 3.8% for global growth. It represents what economists call a new normal of slower expansion. But the World Bank is even more pessimistic. They've downgraded their 2025 global growth forecast to just 2.3%, a significant reduction from their previous projections. They're only expecting a tepid recovery in 2026 and 2027, which means we're looking at an extended period of below-trend growth. Here's where it gets interesting. This isn't uniform across regions. The US is getting upward revisions in growth forecasts, while other major economies are seeing downward revisions. This divergence in growth expectations is another factor driving currency movements and capital flows. What does slower global growth mean for real people? Slower job creation, reduced business investment, tighter household budgets, and more cautious consumer spending. For investors, it means lower corporate earnings growth, reduced dividend increases, and more volatile markets as investors chase fewer growth opportunities. In a slow growth environment, certain sectors become more attractive: utilities, consumer staples, and companies with strong dividend yields. Growth stocks become more valuable because genuine growth becomes scarcer. This is fundamental portfolio rebalancing territory. The fourth major development this week comes from the Bank for International Settlements. That's the central bank of central banks. And honestly, their warning should send chills down every investor's spine. They called this a pivotal moment for the world economy, with US-driven trade policies literally fraying the global economic order. This isn't just some academic concern. Trade policy uncertainty is already wreaking havoc on global markets. Businesses are delaying investment decisions because, well, they just don't know what trade rules will look like next year. Supply chains are being restructured at enormous cost, and international partnerships are being questioned. Here's the kicker. This trade uncertainty is expected to push inflation higher next year, which really limits central banks' ability to cut interest rates further. So, we're getting a double hit: slower growth from trade disruption and higher inflation from policy uncertainty. For businesses, this creates what economists call an uncertainty premium. Companies demand higher returns on investments because the policy environment is unpredictable. Unfortunately, this reduces overall business investment, which slows economic growth and job creation. For investors, this means higher volatility, more defensive positioning, and a focus on companies with strong domestic market positions rather than those heavily dependent on international trade. Here's perhaps the most concerning development of the week, and honestly, it's something that should terrify every investor with U.S. assets. A new survey reveals that 2/3 of global reserve managers now fear that Federal Reserve independence is at risk. Think about who these people are. They manage trillions of dollars in reserves for central banks, sovereign wealth funds, and major institutions around the world. These are the ultimate sophisticated investors, and they're expressing some pretty serious concerns about the stability of the U.S. financial system. Nearly half of these reserve managers think the rule of law in the United States might deteriorate enough to significantly influence their asset allocation decisions. When the world's largest institutional investors start questioning the fundamental stability of your financial system, that's when you know we're in uncharted territory. This isn't just theoretical. We're already seeing central banks diversifying away from dollar reserves. China, Russia, and other major economies are reducing their dollar holdings. Even traditional U.S. allies are exploring alternatives. So, what does this mean for markets? If global reserve managers start significantly reducing their U.S. asset allocations, it could create sustained downward pressure on U.S. bond prices, upward pressure on interest rates, and increased volatility in U.S. equity markets. For individual investors, this suggests the importance of international diversification has never been higher. Holding some assets outside the U.S. financial system isn't just about portfolio diversification anymore. It's about systemic risk management. Now let's connect these dots, because these 5 developments aren't happening in isolation. They're part of a larger transformation of the global economic system. We have central banks diverging, currencies realigning, growth slowing, trade relationships fracturing, and confidence in the dominant financial system eroding. This isn't just a rough patch. This is a fundamental shift in global economic power dynamics. History shows us that transitions between economic orders are typically turbulent. We saw this in the 1930s, the 1970s, and we're seeing it again now. The question isn't whether change is coming, it's how quickly it happens and whether we're prepared for it. But here's the thing about major economic transitions. They create enormous opportunities alongside the risks. Currency volatility creates trading opportunities. Growth divergence creates investment opportunities. Policy uncertainty creates opportunities for nimble businesses and investors. So, what does this mean for your investment strategy? First, diversification is no longer optional. It's essential. Geographic diversification, currency diversification, and asset class diversification. Second, consider the implications of sustained dollar weakness. International stocks, commodities, and real assets become more attractive in a dollar decline environment. Third, in a slow growth world, quality becomes paramount. Companies with strong balance sheets, sustainable competitive advantages, and reliable cash flows become more valuable. Fourth, consider alternative investments that can benefit from volatility and uncertainty, real estate, commodities, and even certain cryptocurrency exposures as alternative store of value assets. Finally, maintain liquidity. In uncertain times, having cash available to capitalize on opportunities is crucial. These developments aren't just abstract economic theories. They're going to impact your investments, your savings, your career, and your financial future in very real ways. The mainstream financial media either ignores these connections or oversimplifies them, but understanding these dynamics is crucial for financial success in the coming years. If you want to stay ahead of these massive global shifts, you need to stay informed with analysis that connects the dots. Hit that subscribe button and ring the notification bell because every week I break down the most important economic developments that will impact your financial future. And here's what I want you to do right now. Drop a comment below telling me which of these 5 developments concerns you most. Is it the central bank divergence, currency instability, growth concerns, trade uncertainty, or the crisis of confidence in the US financial system? I read every comment and often use your questions and concerns for future deep dive videos. So, here's your comprehensive weekly takeaway. We're witnessing a fundamental shift in global economic power that's happening faster than most people realize. Central banks are diverging, currencies are realigning, growth is slowing, trade relationships are fracturing, and confidence in the existing financial order is eroding. Remember, in times of economic uncertainty, knowledge is your greatest asset, and taking action based on that knowledge is your greatest advantage. Until next week, stay informed, stay prepared, and most importantly, stay ahead of the curve. Thanks for watching, and I'll see you next week for another deep dive into the forces shaping our global economy.